Sure. Okay, so let's say you buy a house 500,000 and you're using this loan. The 20% portion will be 100K. Okay, so in the time being, you're going to be responsible for making mortgage payments on the 400,000, which is the remaining balance, plus the property taxes and insurance. Let's say you live in the property for 10 years. Okay, and then you decide, you know what, it's time to upgrade. I'm going to sell. So if at the 10-year mark your selling price is now $1 million, that means your property value doubled. It appreciated 500,000.
Hi everybody, Jose Luis Morales here. Welcome back to another episode of the Morales Group Show. Today we have a repeat guest. His name is Jonathan Sandoval. He works for the Money Store, and today he is going to be going over a new loan program called Calhfa or Calhfa Dream for All Shared Appreciation Loan Program. He's going to be sharing with us what is it, who qualifies for it, and basically what this loan has to offer. Welcome back to the show, Jonathan. How are you?
Thank you. I'm doing good, doing good. I'm excited about this program. A lot of interest is going around, and I think it's going to be good for a lot of first-time home buyers out there.
Absolutely. So let's jump right in. We've already introduced you in a previous episode, so let's just jump right in. What is the California Dream for All Shared Appreciation Loan Program?
Okay, so basically, this is a brand new program run through the state agency, which is Calhfa, which stands for California Housing Finance Agency. And essentially, they're partnering up with first-time home buyers to get them into homes. So this is the first time I've seen assistance this large. I think maybe they had one way back in the day, but it hasn't been around for many years. And essentially, they are letting first-time home buyers borrow 20% so that they could put that as towards a down payment and get a little bit of better affordability when purchasing a home. The thing that they're doing is that they're letting people borrow 20%. That does get paid back with a portion of the appreciation of the home. So they are making money on it, but at the end of the day, if this allows a buyer to get into a home where previously maybe they didn't qualify, this is going to be a big benefit.
Okay. So if I'm understanding correctly, if they're allowing you to borrow 20% down,
Mhm.
that would almost be like buying a property with you coming in $0 out of pocket, or is there still some cost associated with that?
So in order to do the $0 out of pocket, you would have to take a portion of that 20% to pay for your closing cost. However, I'm not really recommending that unless absolutely necessary. And the reason for that is that if you do not apply the full 20%, then we're going to have that conversation of adding mortgage insurance back in it. As you know, anything under a 20% down payment when it comes to mortgages, we're going to need to see some mortgage insurance into that payment, need to add that in. So if you apply the full 20% and pay for your own closing cost, then at that point, it's going to be a lot better on the payment. And you really just have to pay for your closing costs, which sometimes can be negotiated if you can get a credit. But worst case scenario, you cover your own closing cost, and it's going to be better on the terms.
I love it. So if it was negotiated by the seller and the seller pays for your closing costs, it could be like a 0% down type of loan, basically, in
That
other
is
words.
correct. Yeah. Yeah. You could
That's
essentially
correct.
come in with little to no money out of pocket, which is, as you know, is very rare.
Yeah. So how does it work? Like, so they're essentially letting you borrow the 20% that you would normally put as your down payment. Does that 20% have a payment? Is it a silent second? Is there a mortgage payment on that 20%, or how does that work?
So there is going to be no mortgage payment, no monthly payment. It's going to be a silent second, meaning it's going to be a second mortgage on your home. It's going to be on title. And that original principal balance will remain until it's paid off, where they will calculate what the appreciation has been and how much would be owed at that point. So it's going to be a silent second. You're only going to be responsible for making the monthly payments on the main mortgage, the first mortgage, along with your property taxes and your insurance.
Okay. Now, on the silent second, is there interest on top of the appreciation, or is the only thing that is calculated on the silent second the appreciation?
Only the appreciation. There is no fixed interest rate whatsoever on that. So a lot of people, it's very rare that this will happen, but one of the big questions was, well, what if my house doesn't appreciate? What if the value goes down? Well, at that point, the only the principal balance will be paid back, the original amount, whether it's the same or less. So there's going to be no additional interest if the house did not appreciate. So it's only on the appreciation.
So meaning like let's say that I buy it for 500 and then one day I want to sell it for 500 and then
Mhm,
from the 500 they let me borrow $100,000 for the down payment. I would
mhm,
literally just pay the 100,000 back and
mhm.
the original first loan, and there's no additional fees. In other words, basically the only time uh Calhfa or Calfha makes money is if the home appreciates, basically. So it's almost like you're getting a 20% loan on it,
Mhm.
but that loan only makes money if the house appreciates, which is like almost like a partnership, almost like
Exactly.
literally like it is a partnership almost.
That's exactly right. Yeah. So, I mean, it's beneficial for the buyer because they're really only paying more, but at the end, if their house appreciates, they're also gaining more equity. So it's beneficial in both ways.
Okay, so can you give us an example of how it would work? Like, let's say that the property doubles. Like, let's say, give us an example. Like, let's say you buy at 500,000, and then it doubles to $1 million. Like, and you got the 20% down. How would that work if you did sell the property?
Sure. Okay. So let's say you buy a house 500,000 and you're using this loan. The 20% portion will be 100K. Okay. So in the time being, you're going to be responsible for making mortgage payments on the 400,000, which is the remaining balance, plus the property taxes and insurance. Let's say you live in the property for 10 years. Okay. And then you decide, you know what, time to upgrade. I'm going to sell. So if at the 10-year mark, your selling price is now $1 million, that means your property value doubled and it appreciated 500,000. So the original loan amount was 100,000, but because your property value doubled, that principal loan amount now goes up to 200,000. Okay, so you would basically pay back for the second mortgage double because the home doubled in value. Okay,
I
so
love it.
it really just depends on the appreciation. Now, a lot of people are like, "Wow, that's I'm losing equity here." But if it allows you to gain the remaining 800,000, that's still a win at the end of the day.
It's almost like if you had a partner that said, "Hey, look, I'm willing to help you use your first time home buyer benefits. You can benefit in everything in the interest rate, in the principal, pay
Mhm,
down,
mhm.
everything. I'll basically let you borrow the 20%, and then if it appreciates in value, you double my money, whatever it appreciates, basically."
That's correct. Yes, yes, that's exactly how it works. So it's essentially they're partnering up with buyers. They're going to essentially own a portion of the equity in your home.
Yeah, not double up. It basically relative to the percentage that they put.
Yes,
Okay,
that's correct.
okay. So this all sounds fantastic. Uh, who qualifies for this?
Well, first things first time home buyers only, meaning that you cannot have owned a principal residence in the last 3 years. Same goes for a spouse. Let's say your boyfriend had owned a home, then you guys got married and you moved in with your boyfriend, state of California, community property state. That also means that you're no longer a first time home buyer. So that's going to be the main thing. Secondly, minimum credit score would be 680 if you're above the 80% of the AMI limit, which I'll get into in a second. And that those are the two biggest things. They do not allow cosigners. They do not allow non-occupant co-borrowers. So it really just needs to be your own qualification or whoever's going to live in the home. And as far as property goes, a lot of properties qualify as long as they're single unit. So single family residences, condos, new builds, as long as they're single family, they do allow for a property to have an ADU, just no duplex. You can't have it won't, if it's a duplex, it won't qualify.
I love it. Okay. And then are there certain things that like if certain things happen where the loan becomes due on the second, is it a 30-year loan? Is it a 15-year loan? Is it a 10-year loan? How does that work?
Yeah, so 30-year loan right off the bat, and these are going to be the scenarios where that second mortgage is due. The most common one will probably be when you sell. When you sell the house, that at that point, whatever the house sells for, they're going to calculate the appreciation and you pay back that loan. If you never sell, then it would be at the end of the loan term, which is a 30-year fixed mortgage. Okay, they do allow you to refinance one time. And because of the current market of where interest rates are currently at, we can anticipate that they will drop in the next few years. So they do allow for you to refinance to lower your mortgage one time without needing to pay off that second mortgage. The second refinance at that point, if you did do that, then it would be due.
Okay, that makes sense. Now, I know that it's for first-time home buyers, and I know that it's for owner occupied borrowers as well too. What if I buy as a first-time home buyer, but 10 years down the line, I decide that I want to hold on to the property, but
Mhm.
now instead of living there, I want to rent out the property? Are there any deed restrictions there?
No, no. So you actually, the same rules apply as far as the occupancy. When you buy an owner occupied property, you are basically signing that you intend to live in the property for 12 months. Okay, so only 1 year. After that, if you decide that you want to keep that, maybe buy something else or just move elsewhere and rent that out, that is allowed.
Okay. So there's no like deed restriction or anything like that basically on
Mhm.
the property. Okay.
No.
Now, what if like I know that they participate in the appreciation, but like let's say I bought at 500 and then I do $200,000 worth of renovation, so I'm into it for 700.
Mhm.
Is the appreciation only the 300 since I put $200,000 out of pocket, or does that not get factored in, or is that still not known, or how does that work?
Yeah, that does not get factored in. So they're going to strictly go off of the new value of the home. So in a way, yes, if you do renovations worth 200,000, they're not going to give you 20% of the 200,000 to help with the renovations. There, that at that point, that's your choice as an owner. So they would in a way benefit from that because that does help the home appreciate.
Okay. So it's almost better. No. So I guess my question would come in. So if you buy at 500
Mhm.
and you sell at 1 million, the appreciation, even if you put 200,000 into it over the time, is 500,000. It's not
Mhm.
300,000. Basically,
Mhm.
that it's a very simple formula. In other words,
Yep. Yep.
so it's almost better to buy a fully renovated property if you're going to do something like this versus a fixer upper. Now, is would you say that this is like a long term program for people if they want it to be, or would you say that some people are looking at it from a short term basis, like maybe this will help me get into a loan, build up some equity, but maybe I don't want to share that all of the equity over the lifetime with Cal HFA?
Mhm.
Uh, how do you view that?
So, in my opinion, the best way to go about this loan, because it is so new, it's not something that's very common. But the way I would do it is I would look at it as a short term loan. And what I mean by short term, I probably say somewhere between 5 to 7 years at most. And that's if you plan on keeping the home. Because a lot of people plan on buying a house and keeping it, renting it out later on, which is excellent. That's fine. But really, really keep an eye on that equity so that you can eventually pay back that second mortgage, but not let your house appreciate too much before that loan balance just continues to grow. So I view it as more of a short term thing. And yes, you're allowed to keep it for as long as you like. Just know that the longer you keep it, the more likely it is that your house is going to continue to appreciate. Therefore, that second loan balance will also continue to climb.
I love it. Okay. And then let's talk about like loan to value ratios. Let's talk about, are there any income limits, income
Mhm.
requirements, uh, what the underwriting process looks like?
Yeah, so the income limits are pretty high. I mean, they're going to be varied by county. And for example, the one in Ventura County where we're located, that is an annual income limit of 228,000 for anybody who's going to be on the loan. So if it's a husband and wife, wife makes 100,000, husband makes 100,000. That's 200K combined. They're under that limit for Ventura County. Now there's a spreadsheet for every single county in California, but they are very lenient from what we've seen in the past. You know, sometimes they've like last year they released a loan program where the income limit was a lot lower, making it a lot harder to qualify because the less income you have, you know, the less mortgage you can afford. As far as underwriting goes, it's very similar to any type of traditional underwriting process, with the exception that you will have to we as lenders send it to the state agency so that they can do also their checks and balances.
Mhm.
And an additional step that is also added for the buyer is that they are required to do a education course online. For this particular program, there's the standard 8 hour course that you complete online. It's cost $99, but they also added a shorter one that is specific to the appreciation of the Dream for All program. So there's basically two online courses that they would have to complete.
Yeah. Do they allow non occupying borrowers, people that are not going to live in the property?
No, absolutely not. So no cosigners. A lot of times first-time buyers do use cosigners, maybe a parent, maybe a sibling. But in this particular program, it really has to be just your own qualification, your own credit, your own income to basically prove that you can afford the payment.
What is really good, the resubordination as well too, how you said that if they had the opportunity to refinancing the
Mhm.
first and still keeping the second. So like if interest rates drop to 4%, you can drop the interest rate from whatever they're at now to 4% and then still keep that second loan as a one-time thing. So it's almost like trying to time it at that point to see if you can get that payment down at some point. So that's really awesome. Anything else, Jonathan, that we might have missed as it relates to the California Dream for All Shared Appreciation Program?
Yeah, a big thing that I would add in there is that this is a limited program, not going to be around for a very long time. And the reason for that is because of the funds that were allocated towards the program, which is $300 million. So if and this is for the entire state of California, which, as we know, prices where they're at. If we calculate that the average home price, and I think I'm going low here, is 500,000. That means that the second mortgages will be 100,000, meaning only around 3,000 people will be able to take advantage of this program. So it's only gonna it will not last, I think, till the end of the year. I think it's gonna last, quite honestly, 4 to 5 months, in my opinion.
Okay. Now, if somebody wanted to do this program or wanted more information on this program, how can they get a hold of you?
They can reach out to me via my cell phone is always going to be the easiest way to contact me. Call or text 805-754-1921. I'm also on multiple platforms on social media. So they can always reach out to me there, follow me, and send me a direct message as well.
I love it. All right, Jonathan. Well, I want to say thank you so much for taking the time to be on the show. For all of our viewers out there, we had Jonathan Sandoval. He works for the Money Store. He went over the HFA Dream for All Shared Appreciation Loan Program. And if you have any additional questions, feel free to reach out to him. And thank you guys for watching. If you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode will be helpful to somebody, make sure to hit that share button and share this video with a friend. Thanks again, Jonathan, and appreciate your
Thank
time,
you.
and look forward to the next interview.
All right. Thanks a lot, Jose Luis.